Inox Wind has been making headlines lately. Just yesterday, the stock shot up by a remarkable 20%. Over the past year alone, Inox Wind has continued to deliver multi-bagger returns with a remarkable surge of more than 300%. So what's driving this incredible surge? Let's dive in. Inox Wind Limited is a part of the Inox GFL Group, a company with a legacy of over 90 years in India. Now, Inox Wind operates in the rapidly growing renewable energy industry. Since 2009, they've been actively involved in manufacturing and selling wind turbine generators. They also offer a full range of services, including engineering, procurement, commissioning, as well as operations and maintenance. Now, basically, they're like a one-stop shop in the wind energy sector. Now, if you look at Inox Wind journey, it's been quite a ride, much like its industry peer Suzlon. The company has faced significant challenges along the way, particularly with frequent policy changes in the wind sector and the disruptions caused by the COVID-19 pandemic. Now, these factors severely impacted wind capacity additions across the industry, and this also impacted Inox Wind's operations. Now, if you want to know more about the policy changes and its impact, do watch our video on the wind energy sector. Now, coming back to the story. During this tough period, Inox debt levels went up considerably, adding to the pressures on the company. However, there's been a positive shift recently. The company has been actively deleveraging, meaning they've been paying down their debt, and by the end of fiscal year 24, their net interest-bearing debt had reduced to around 655 crore rupees. Now, the management has been pursuing a strategic initiative to cut down interest-bearing debt through a series of promoter stake sales and equity infusion. And by Q1 fiscal year 25, which is a recent quarter, the company has reduced its external debt to zero. Now, this deleveraging effort has played a crucial role in fueling the stock's recent surge. Now, fiscal year 24 has also been a turnaround year for the company's profitability. While the company still ended in losses for the full year, the 4 quarters of fiscal year 24 painted an interesting picture for the future. In Q1, the company turned EBITDA positive. In Q2, the company witnessed cash profits. And in Q3, the company posted profits after more than 12 quarters of losses. Now, fast forward to Q1 fiscal year 25, and the momentum has only continued. The company reported an 83% year-over-year revenue growth for the first quarter, and even more impressive is their net profit of Rs 50 crore compared to a net loss of Rs 65 crore in the same quarter of last year. Now, when it comes to wind turbine manufacturers like Inox Wind, the real indicator of success is how much business they're securing. And right now, as of the recent quarter, Inox Wind's order book is at an all-time high, standing at 2.9 gigawatts as of June 30, 2024. Now, this is a staggering 254% year-over-year growth. Now, this impressive order book is set to keep them busy at least for the next 2.5 years. In terms of execution, the company reported 140 megawatts completed during Q1 fiscal 25, which is an increase of 112% compared to the same period last year. So when we look at the overall performance of Inox Wind stock, a few key factors really stand out. First off, the company has a robust order book, which gives it solid revenue visibility. Essentially, we know they have a steady stream of business lined up. Then there's the strong execution capability, meaning they're really good at delivering on these orders, and that's crucial for maintaining growth. Now, another important point is that they're net interest-free debt, which is a huge advantage because it means they're not weighed down by costly debt repayments. Now, adding to this, the government has also recently renewed its focus on wind energy, which is a major boost for companies like Inox Wind. Now, it's no secret that the renewable energy space is growing rapidly. Factors like decarbonization, energy security concerns, falling costs have driven renewable energy capacity by more than 100 gigawatt over the last decade, reaching 190 gigawatt by fiscal year 24 in India. And this is expected to rise to 500 gigawatt by 2030, with a substantial portion, which is 140 gigawatt, expected to come from the wind sector. Now, considering all these factors, it's clear that Inox Wind is well positioned to continue building on its growth momentum. But what should you keep an eye on? Well, we've seen a lot of government interventions, frequent policy changes over the past decade. This caused a slump in installations and led to highly leveraged balance sheets due to steep fall in wind capacity additions in India. However, recent favorable policy changes have started to turn things around. That said, we should be cautious about any potential policy flip-flops since the wind sector is highly regulated. Now, while Inox Wind's order book is strong, if it takes longer than expected to start and complete their projects, it could slow down their business growth and impact their financial performance. Now, competition is another factor. At the moment, only Suzlon and Inox are executing concept to commissioning projects. Suzlon holds a market share of around 32%, while Inox Wind holds around 15%. Now, recent positive developments have significantly boosted their stock performance, but it's important to keep an eye on valuations. We want to make sure that these stocks remain attractive investments based on their financial health and their valuation. And just to wrap things up, remember this video is for educational purposes only and does not constitute investment advice. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.